Welcome to Yahoo Finance flagship show, The Morning Brief. I'm Julie Hyman. Let's get the 3 things you need to know today. President Trump following through on his threats to slap tariffs on heavy trucks, furniture, and pharmaceuticals. For home goods, 2 different tariff rates will go into effect next week. A 50% rate on items like kitchen cabinets and a lower 30% rate on upholstered furniture. The news weighing on furniture companies this morning. But there's a big loophole for the drug makers. As long as they're building manufacturing plants in the United States, it appears they're off the hook. And we have seen companies announce major investments in recent months. One estimate putting it at a total of $350 billion so far. Plus, the inflation picture a little more clear this morning. The PCE index coming in line with expectations at 0.3%, but the consumer still showing signs of strength. Both income and spending rising more than estimated. PCE is the Fed's preferred inflation gauge, remember, and depending on what happens with the government shutdown, it could be one of the last pieces of economic data before the October Fed meeting. U.S. stock futures little changed ahead of the open, as investors have all of these macro factors to consider, from the health of the AI trade to tariffs. And the Trump administration may make a new effort to promote chip manufacturing in the U.S. The Wall Street Journal reporting the administration is considering a plan to have chip makers produce the same number of chips here in the U.S. as their customers import from overseas. And if a 1-to-1 ratio is not maintained, companies could face a tariff. Let's get a check-in on stock futures after what has been a more rocky week for stocks than we have seen as of late here as we get closer to the end of September. Traditionally, not a great month for stocks, but this one has been. So this morning, we do see indications of a higher open. The Dow indicating a gain of about 0.5%, leading the major averages this morning. The S&P about 0.25%, and the Nasdaq almost 0.2%. Let's dig into our top stories of the day. Core PCE, the Fed's preferred inflation gauge, in line with estimates. This as stocks come off 3 straight days of losses. Plus, President Trump announcing sweeping new tariffs set to hit pharmaceuticals, furniture, and trucks starting October 1st. Joining me now, Federal Reserve correspondent Jennifer Schonberger, senior reporter Brooke DePalma live at the NASDAQ, and Niall Stanage, White House columnist for The Hill. Niall, I'm actually going to start with you and the tariff headlines that we're getting this morning. Now, this is something that the president has talked about before. The timing, perhaps, and the implementation may be a little surprising. Talk us through what we know this morning and kind of your perception of the news.
So I think the big headline, obviously, is this large tariff proposed on pharmaceuticals. But there is quite a large asterisk to that headline, and you have just outlined why. There's this massive loophole for pharmaceutical companies that are breaking ground to build new plants in the United States. That seems to ease the problem there quite a lot from the pharmaceutical companies' perspective. There is also briefly a question about whether this goes on top of a 15% tariff that has already been agreed with the European Union in terms of drug imports. Obviously, the other tariffs like large trucks could have an impact, but we haven't so far seen the tariff regime from the Trump administration having quite the inflationary effects that we would expect. And just one final point, Julie, I would say, politics always plays into this, not only in terms of the big picture, in terms of President Trump's desire to bring manufacturing back here, but also in some of the specifics. The first thing I thought of when I saw this 30% tariff proposed on upholstered furniture products is that the furniture industry had at one point been very important in North Carolina, which is also a very politically important state, both in presidential elections and in Congress.
Yeah, and to your point, that asterisk with the drugs doesn't exist with some of these other products. But I want to get to Brooke for a moment because it's interesting to see the stock reactions across these various categories that are affected by these newly announced tariffs.
Yeah, first let's kick off with the industry that you were just highlighting, and that's pharmaceutical. What we've heard from so many of these companies, including the likes of Eli Lilly, Johnson & Johnson, as well as Merck, is that we have seen them invest in U.S. manufacturing. And because of that, what we see today, this morning, is this pop in some of the company's stock, like we had mentioned, because They have said that they're investing in U.S. manufacturing expansion, and that is the loophole needed to go into play. And as you could just see before, we're seeing a bit of a mixed reaction when it comes to furniture stocks. We know that, for example, Williams-Sonoma, Restoration Hardware, those have been under pressure because of the impact of these companies to navigate tariffs. Williams-Sonoma, another one that has been impacted well. These are companies that rely on foreign imports, rely on foreign sourcing to bring to here in the U.S. Now, on the flip side of this, we see Ethan Allen, a company that is based here in the U.S., produces a U.S. furniture manufacturer, popping this morning because of this news that these companies that manufacture here in the U.S. will ultimately be rewarded. They won't have to pay that tariff. And then lastly here is those freight stocks as well. We're seeing a bit of a mixed picture here, certainly as, investors try to assess the risk of overseas freight stocks. You could see Old Dominion popping on this news, XPO, a pretty much flat reaction in pre-market trading. And then another one too, the company behind Peterbilt also jumping on this news. And so investors trying to digest and understand what exactly this means. But what we're seeing here in taking a big picture look back is stock futures are up today. And largely what we saw in the past when these tariff announcements were made is a bit of a downside reaction. And so investors really trying to understand what this means moving forward.
Yes, definitely. And Niall, I want to go back to you because I want to draw a distinction between these announced tariffs and some of the past ones. First of all, there's only a few days until implementation, and the so-called taco trade doesn't really seem to apply here. In other words, the Trump always chickens out. It seems like these are going to go into effect. There's no sort of negotiating them away, right?
It does, although to Brooke's point, I think sometimes one of the reasons why we see a very mild stock market reaction to these announcements is the skepticism about whether they will go into full effect. As you say, there is a very short horizon on these ones, but to get back to the pharmaceutical point, it seems like the impact of that could be quite small. In addition to the issue of drug companies that have manufacturing plants in the US, of course, these new tariffs are to apply to branded pharmaceuticals, in other words, not generic drugs. Generic drugs account for about 90% of the drugs sold in the United States or provided to patients. So I think that's why we're seeing perhaps, or one of the reasons why we're seeing the market taking this very much in stride.
Right. And one of the, there seem to be in the president's drug policy sort of two aims. One, to bring manufacturing back. Two, to lower drug prices. So generic drug prices already tend to be much lower than branded prices. But that price question brings me to PCE and to Jennifer. And those numbers that we got this morning that show on the one hand, inflation wasn't hotter than estimated. On the other hand, it's not slowing down much.
Yeah, it's hanging in there, isn't it, Julie? Another sticky reading on inflation there. Basically a full percentage above the Fed's 2% target. The personal consumption expenditures index on a core basis, which excludes those volatile food and energy prices, clocking in at 2.9% year over year, in line with expectations and holding the same level as July. Remember, this data is for the month of August. And frankly, this was not only expected by analysts, but by Federal Reserve officials themselves. Fed Chair Jay Powell mentioned this very number in his speech back in Jackson Hole in August. So at 2.9%, we're still below the 3.1% that Fed officials expect inflation to end this year before they expect it to come back down to 2.6% next year. And that is because, to your point, as you said, they think this is going to be a one-time increase in prices as far as the impact of tariffs on inflation. They think they can look through this. And while it may be just be a one-time increase in prices, it is something that may not happen all at one time. That said, this is going to be something for the hawks on the committee. We have a very divided Fed right now. We heard from Austin Goolsbee from the Chicago Fed yesterday, who's a bit circumspect about front-loading rate cuts just based on weaker payroll growth for this very reason. We also heard from the head of the Kansas City Federal Reserve, Jeff Schmidt, who also is comfortable after the one cut that the Fed did last week, sort of holding rates where they are right now because he believes inflation is heading more towards 3% than back towards 2%. So it's going to be interesting to see this debate really borne out. Perhaps the biggest determining factor is going to be the next jobs report due out next Friday. Of course, we'll see if we have a government shutdown or not, if that ends up getting delayed.
Yes, and we're going to talk about that much more over the course of the show. Brooke, as we get the PCE data, as we look at the tariff news, what are we hearing from strategists and what are we seeing more broadly in the market this morning?
Julie, taking a step back, yesterday after that GDP report and that lower than expected jobless claims report, there was lower conviction on the street that the Fed would cut rates in October and in December. That markets even priced in a 10% less chance that they would cut rates in December. Now, with this latest news, we are seeing, according to the Fed Watch tool from the CME, we're seeing higher conviction that we will see rate cuts in both October and December, even by a few percentage points this morning. And we're hearing from strategists on the street that this inline PCE today can keep the focus for the Fed on that full employment mandate. They said that will give them room to continue normalization of the Fed funds rate. Also, heading into today, we were expecting this to be the first week of losses for the equity market in the month of September, which typically is very volatile in itself. And now moving in after we see this conviction getting priced into the market that the Fed will cut rates, we are seeing a bit of a turn, at least in these pre-market hours, that all three major indices are moving higher. And so that's what we're hearing from strategists this morning. One, global head of equities at UBS saying that investors really looking to manage timing risks, should consider phasing in and using market dips to add exposure to preferred stocks. And so really right now we're looking at this moment of weakness in what has been a very, very strong quarter heading into the back end of the year. Just on Monday, we heard from Goldman Sachs that they raised their S&P 500 target to 6,800. And so it's been quite the week in markets, Julie.
Yes, it has. Brooke, thanks so much for covering it all for us. Jennifer, Niall, thank you for joining us. Coming up on Morning Brief, we bring you today's top trending tickers as we count you down to the opening bell. Don't go anywhere. Now time for some of today's trending tickers. We are watching Costco, Oklo, and Boeing. First up is Costco. Shares are lower in pre-market trading after the wholesale retailer reported results for the fourth quarter and its full fiscal year after the bell Thursday. In the quarter, Costco's sales and earnings topped estimates, though U.S. same-store sales rose 6%, just shy of estimates for 6.1%. Costco CFO Gary Millerchip highlighted resilient sales on the chain's budget offering, saying consumers are, quote, very choiceful in their spending on discretionary items, those shares down almost 2%. Next up, Oklo continuing to slide after Goldman Sachs initiated coverage of the nuclear company at a neutral, warning there are risks ahead for investors as Oklo still has yet to apply for the permit to open its first nuclear power plant. The pullback coming as multiple corporate leaders have sold Oklo shares. According to Verity data, CEO Jacob DeWitt, Director Michael Klein, and CFO Craig Bielmeier collectively offloaded roughly $20 million in Oklo stock. And finally, shares of Boeing are rising as the Wall Street Journal reports the Federal Aviation Administration will ease restrictions on inspections and deliveries of Boeing 737 MAX. The FAA began requiring agency inspections of each 737 MAX jet in 2019 following two deadly crashes. In 2024, following a mid-flight door blowout on an Alaska Airlines flight, Boeing's production of the 737 MAX was limited to 38 planes per month. The airline reportedly said to regain the ability to perform final safety checks in phases, as well as deliver 42 jets per month. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, the Federal Reserve's preferred inflation measure, the PCE index, showed inflation rose 2.7% year over year in August. Core PCE, which strips out food and energy costs, rose 2.9%. In the wake of that report, a majority of investors still expecting 2 additional rate cuts by the end of the year. That's according to the CME's Fed Watch tool. Joining us now, Seema Shah, Principal Asset Management Chief Global Strategist. Seema, it's great to see you. If I saw these numbers in a vacuum, I would say, why the heck is the Fed cutting rates and why is it expected to continue to cut rates. So what do our assumptions have to be here surrounding those numbers, because they obviously don't exist in a vacuum, to presume that that's what the Fed is going to do?
Hi, thanks for having me on. Yeah, it's a really good question. I think there's a lot of people who may be scratching their heads because when you look at the broad economic picture, the kind of data that we've been seeing in the past week or so, it really does suggest this continued picture of economic resilience. There is still a slowdown, but generally it's fairly robust. But then you look to the labor market where we have seen really clear signs of a slowdown. And although that data is fairly muddy, it's difficult to try and separate what is in impact from immigration, from the administration's immigration situation to what's actually going on with the labor demand. There's enough of a concern there to prompt the Fed to start rate cuts. Remember, rates are still above neutral. So we're still in restrictive territory. So just taking it down to neutral shouldn't really be driving up inflation very significantly. So it is a difficult picture, but at the moment, I think it's fair that the Fed start a series of a couple of rate cuts, maybe 2 more for the end of this year, and then to pause to reassess what the economic situation really is.
How concerned are you about the labor market in the U.S., Seema?
We're not very concerned. I mean, I think the key thing for us is watching initial jobless claims, we did have that spike for 1 week, but they've come right back down again. So they are quite low. Certainly, typically during recession periods, you see initial jobless claims rising to the 300,000 level, and it's meaningfully below that. So we're not seeing an increase in job layoffs. But with labor demand coming down, you can see that with hiring rate having dropped quite meaningfully, there is enough concern that it wouldn't, I guess, harm the economy to have a bit of a rate cut, a little bit of stimulus coming through in order to give the market a boost. But we're not very concerned that this is heading towards recession. It's just about tweaking policy in order to make sure that the expansion does continue.
Seema, we're in this really sort of curious environment where, on the one hand, this administration is viewed as relatively business-friendly, stimulative policies for businesses. You see that in the tax bill and some of its other measures. On the flip side, you see some of the immigration crackdowns. You see the H-1B visa fees. You see the new rounds of tariffs, the new sort of rolling waves of tariffs. How is that balance? I mean, clearly the balance seems to be working out okay for now, but are there risks to that going forward?
I think there are some risks. I think, to your point, the thing that we have observed in the last couple of months is, the fundamental strength of the US is really continuing. And then a lot of the administration's policies are really being directed at strengthening the foundations of the US, the domestic foundations. Now, to your point, going forward, there are clearly some risks. I mean, even if you just look at immigration, although there may be some help for domestic workers today, when you look at over a long term, that cut in immigration does typically weigh on productivity, does typically weigh on long-term growth. So there is some negative impact, but it probably isn't seen for a couple of years yet, which from a market and from an economic standpoint means that at least for now, you can see this continued upward trend.
So does that just mean buy U.S. stocks and keep riding it higher? Seema, what's the strategic move here?
Well, I think the best way of almost analyzing what the impact has been is just looking at the US dollar. So you have seen this continued weakening in the dollar over the last couple of months. And a lot of that is down to concerns around what is actually happening to the strength of the US in the long-term perspective. That's why you're seeing this continuation downward. Now, when you look across the rest of the world, we have got some optimism about various parts, certainly in Asia, the rise of tech in those areas does suggest that there's still opportunities there. But overall, I think our main thesis is global diversification is really key. We can see that the US is doing well. We continue to believe the risk assets will continue to perform fairly well over the next 12 months. So you want to have some exposure to both domestic, some to international, but keeping in mind that given the concerns that are out there, you still need to be thinking about what is high quality and having that focus.
Seema, you raise an interesting point about the dollar as well, because we've been sort of talking about recently the whole sort of sell America trade that was taking hold for a little while seems to have ebbed. But I guess the dollar is the exception to that, right? Is that, as you say, a reflection of some of these concerns about the longer term trajectory? Do you see any change to that movement in the dollar in the near term?
No, because I think one of the key things that we, typically that you see for the US dollar is it's very much driven by interest rate differentials. Now, in the US, you've got the Federal Reserve starting, or at least resuming, its cutting cycle. In most other parts of the world, they've actually come to an end, or at least they've only got 1 or 2 rate cuts still to come. So that interest rate differential does suggest that you could see continued downward pressure on the US dollar. But at least in terms of concerns around the credibility of institutions, some of that has waned. So at least some of those concerns have diminished. So that means that you shouldn't see a very sharp deterioration, or at least weakening in the dollar. But we do expect a bit of a softening over the coming months.
And then just briefly, Stephen, what are the sort of negatives and pros and cons of that weaker dollar for U.S. corporate earnings?
Well, typically a weaker dollar is actually quite positive for corporate earnings, and you can see that. I think that that currency aspect has been really helpful for earnings season. The real worry around a weaker dollar is that it can contribute to inflationary pressures. Now, we already know that the Fed is worried that there's going to be a tariff-induced boost to inflation over coming months, and that weaker currency suddenly doesn't help that situation. So those are the kind of things that we need to think about. And in addition to that, if you're an international investor, if you're in Europe, the fact that the dollar is weakened against the euro has meant that you're more likely to try and invest at home rather than in the US. So there are certainly some implications, but at least from an earnings perspective, that weaker dollar is actually somewhat helpful.
Seema, great to see you. Thanks so much for your time, and have a great weekend.
Thank you.
Thanks. That does it for Morning Brief. Stay tuned for Opening Bid. That's next on Yahoo Finance.